Hi, everyone. Thank you so much for being with us here. I'm thrilled to be sitting down with Caroline Pham. She's the commissioner of the CFTC. Commissioner Pham, thank you so much. Before we get started on our conversation, we do have a poll. I know Shonali referred to one. We created a new one for this conversation. So let's pull it up right now. Do we have it up? If not, I will just read what it is. And there we go. Make sure you scan the QR code. Which government regulator is the most misunderstood? And I gave 4 choices. There's obviously more than 4 government regulators, but those are the ones I picked. The SEC, the CFTC, the Federal Reserve Board, and the Office of the Comptroller of the Currency, or the OCC. I always missay it and say controller when it should be comptroller. So please respond to that poll, and of course we will bring it up later on. But fun fact, Commissioner Pham, you've actually spent time working at 3 of those agencies.
3 of 4, and I did interview for the 4th one, so.
You did?
I did.
Okay, so you interviewed for the Fed, and you actually worked at those 3. Let's be clear, though, when it comes to the foreign exchange markets, and I know that our audience is very focused on FX, the CFTC is the agency that actually oversees and regulates the foreign exchange market, right?
That's a complicated answer, as everybody in this room is aware. But so it's the Treasury Department, and then the bank regulators, of course, the Fed and the OCC, and to a lesser extent the FDIC oversee the activities of banks, which typically are dealers in FX. And then the CFTC has jurisdiction over FX swaps. And I'm going to mess up the rest of it, so I'm going to just leave it as it is. But there is a letter between the Treasury and the CFTC. It was a big part of Dodd-Frank.
Okay, so it's complicated, but that's also because the currency market is huge.
It is.
It's vast. It's largely OTC. It's the most. It's the biggest and most liquid financial market in the world, and certainly the most global. We will get to that shortly, of course, but I do want to start with your personal history, because I'm fascinated. You're a Vietnamese American woman. I'm Chinese American, so bravo, first of all, for being the first Vietnamese American woman to be appointed by the president, approved by the Senate. Well done.
Thank you. Thanks so much.
Help us understand your path to becoming a commissioner at the CFTC, because as you mentioned, you had worked at 3 of those agencies we mentioned. You interviewed at the 4th one. You majored in poli-sci at UCLA, and then you went to law school. Was your plan to eventually go work in the public sector as you are now?
So I'll give my disclaimer really quickly, which is that today my remarks are just those of my own in my official capacity as a commissioner, and do not necessarily represent that of the CFTC or of any other commissioner, particularly my personal history, obviously. So I did not know that I wanted to go to law school, or that I wanted to, I did always want to do public service. So my parents came over during the Vietnam War. They were airlifted on the last day of the Vietnam War from the U.S. Embassy. And so we were always raised to be grateful for having these new opportunities here, a real American dream kind of story. And so I always wanted to give back. Actually, when I was a kid, I really wanted to be a CIA agent like Jack Ryan in this Tom Clancy novel. So maybe there's still time for me. And I did do Army ROTC after 9/11 when I was at UCLA. Anyway, I graduated from UCLA. I had done a lot of different things. I had an internship in DC. I had done internships in fashion and entertainment in LA. I still didn't know what I wanted to do, so I actually got a job at Sullivan & Cromwell in the LA office, mergers and acquisitions and private equity as an assistant. And it was an incredible eye-opening experience for me to kind of come from a small sort of agricultural area and then see the world of high finance and mergers and acquisitions and these big deals. And it was also in the run-up to the financial crisis. And so it just so happened that me going to law school coincided with the financial crisis. So when I started in law school, it was 2008. And I felt like I wanted to do something to give back and help out, the same reason why I signed up for Army ROTC after 9/11. And being in Washington was a fantastic opportunity to do internships right here in our nation's capital. So my summer after my first year of law school, I externed for the former chief judge of the Court of Federal Claims, and he was still working through these cases from the savings and loan crisis when all of those banks failed, and then they sued the government for breach of contract. And so here I am working on these cases from the savings and loan crisis and understanding
decades earlier.
Exactly, and understanding the dynamics there. And then we're going through the great financial crisis in 2008. So it's interesting to see the parallels there. That really got me interested in financial regulation. Then I did the internships at the CFTC, and I was working on oil and energy manipulation cases. At the SEC, I was working on complex structured financial product fraud. And then at the OCC, I was in the Enforcement and Compliance Division working on some very major AML investigations, and then smaller cases where there's community bank officers or directors who are misusing the bank and are getting banned from the business of banking. And I was fortunate in that, and then I split my summer with a law firm, a consumer financial services boutique. Well, when I entered my third year of law school, I had a job, I had a clerkship offer, I kind of thought I was going to take it easy. And then my former supervisor at the CFTC had gone to detail with a commissioner, Commissioner Scott O'Malia, who's now the CEO of ISDA. And he said, would you like to come and intern for a commissioner? And here, Dodd-Frank had just been passed. And I'm thinking, what a moment in history. It would be a real disservice to myself to not go for it. Chairman Gary Gensler then at the CFTC, and the CFTC has this huge mandate under Title VII to regulate the OTC derivatives market, and so I just went for it. In law school, it was really, I just felt like Goldilocks. I wanted to try all the different agencies and sort of understand the breadth of the different aspects of the financial system, because I had studied actually Dodd-Frank and worked on it when I was in law school. I had a professor that was involved in doing white papers with the American Bar Association.
Did you seek that out, or was that kind of, it fell in your lap, it was a happy coincidence? Focusing on financial regulation and focusing on Dodd-Frank and all of that.
Yeah, so it started with the cases that I did for my judge with the savings and loan crisis. I had actually seen some of the run-up to the stresses that led to the financial crisis when I was at Sullivan & Cromwell, because of course they were working on many of these very big deals, Bear Stearns, Washington Mutual, I think all of them. So I actually remember being in Washington because I transferred from the LA office to the DC office to work full-time and go to law school at night, actually, is how I started off at law school. And they asked me if I could come in on a weekend. I said, sure. And it was the weekend that I think Washington Mutual had their board meeting to agree to sell the assets to JP Morgan. So really, again, just being right there in a moment in history. I liked it. I thought it was interesting. I wanted to give back. And that's what got me interested in financial regulation. And then I started trying all the different ones. And this one was too big, and this one was too small. And then the CFTC was just right. It was the
Which one was too big?
The SEC.
The SEC was too big.
The OCC was too small.
Okay.
The CFTC was just right. I'm very proud to be back at the agency for the fourth time, actually, because after interning for Commissioner O'Malia, I graduated law school, of course. I then stayed home and had my daughter and was a visiting fellow, part-time visiting fellow at a think tank that GW Law has. And it is, I think, getting more and more unusual for women to stay home, and then it's challenging to return and go back to the workforce. And so that's actually when I interviewed with the Fed, because when my daughter was about 20 months old, I wanted to go back to work, and I interviewed with the board of governors of the Federal Reserve System's legal department in DC. But Commissioner O'Malia had a spot for me to come back to his team, and so I went back there. And then when his term was over, that's when I got the job at Citigroup to start a new team in compliance focused on Dodd-Frank implementation and global regulatory reform. And then I moved to New York.
Okay, so there's a very consistent thread there, but going back to your time when you were trying out the different agencies, one thing I noticed in your bio is that you worked in enforcement across these different agencies. How intentional was that? So
enforcement is, for the SEC and CFTC, we are enforcement agencies. Most of the work is enforcement. Even now as a commissioner, probably 80% of my time is enforcement actions. So it's a numbers game. That's where a lot of the internships are. But again, I was in the Army ROTC. I wanted to be a CIA agent. Clearly I'm very interested in justice and fairness and law and order. I did actually also have an internship offer that I accepted to be at the Department of Homeland Security that same summer that I had the judicial externship. But it took too long for the federal government to process my background check, that by the time they said, okay, now you can start, I'm like, well, summer's over. I have to go back to class full time.
The wheels of government move slowly sometimes.
That's right.
One person who is influential in your career is Philip McBride Johnson. How many of you have heard of his name?
Oh,
okay, I see one hand raised. He taught a derivatives class at your law school, right? He served as chairman of the CFTC. And he helped set clear boundaries between the SEC and the CFTC and their jurisdictions. Can you tell us a little bit about your interaction with him and how that put you on the path to choose the CFTC at the end of the day?
So I think it was coincidental that I just happened to be taking regulation of derivatives the same semester that I had the internship at the CFTC. And so, of course, I told my professor that I was interning at the CFTC. One of the things that was amazing to have a professor, and this is one of the things I think that's very unique about going to law school in Washington, is you do get these luminaries, these policymakers who teach your classes. And he would tell all of these stories about sort of how the CFTC was created. You know, the CFTC, the roots of the CFTC go back to the late 1800s, early 1900s, but up until the CFTC was created as an independent commission in 1974, Congress passed the CFTC Act of 1974. We actually were part of the Department of Agriculture, and I believe we were in the basement of the Department of Agriculture. So, you know, it goes to show how the agency's progressed since then. So that was an incredible experience to just sort of understand the genesis of the derivatives markets, having started with agricultural futures in Chicago and so on and so forth. One of the things I remember him teaching us was about the Shad-Johnson Accord, which of course he called the Johnson-Shad Accord.
As you would.
But this was between, of course, CFTC Chairman Philip McBride Johnson and SEC Chairman John Shad. And I think it was in the 80s, and it was one of the first, I think it was the first accord between the two agencies as to how to delineate their jurisdiction.
Right, to make clear boundaries between who oversees what and what responsibilities you have. Let's bring up the poll for a moment here. I want to see what the results are. And again, the questions were, which government regulator is the most misunderstood? Do we have the results? Okay, there we go. The SEC, 14%. The CFTC, 24%, and the Federal Reserve Board, 20%. And the Office of the Comptroller of the Currency, 41%. I guess no one really understands what the OCC does.
I am surprised by this because I would think it was the CFTC. Most of the time when I travel and I speak to international audiences everywhere, or when I was briefing the board in my previous job or the various legal entity boards and so on, it would be, you know, what is the CFTC exactly? And why do you have two different regulators over the markets? Because in most other jurisdictions, there is a prudential authority, and then there's like a conduct authority, which oftentimes includes the markets. So I'm surprised by that. But yes, I guess because the OCC is not normally talked about. It's a bank supervisor, right? It regulates all of the biggest U.S. banks, and but they focus on their supervisory authority is through examinations and through letters, and a lot of times it's sort of like going to the bank regulator. It's like a mother, may I? Can I do this? Can I do that?
Asking for permission before you can move on.
That's right. As opposed to the SEC and CFTC, which of course get big headlines because of the enforcement actions that they bring, which can be in the billions of dollars.
And of course, more recently, the SEC and the CFTC in particular, when it comes to cryptocurrency and what's allowed, what's not allowed, and coming down with decisions, and the advent of Bitcoin, spot Bitcoin ETFs, and perhaps soon spot Ether ETFs as well. All right, thank you so much for answering all of that and sharing with us your personal history a little bit. I want to transition right now to artificial intelligence, because that is the topic du jour, right? It is what everyone's talking about, certainly what everyone in the markets is excited about. Could you start us off by giving us an overview of what you've observed so far about how market participants are using AI in their daily operations? What does the CFTC see?
Right. Well, I can tell you what I saw when I worked on AI when I was at Citi. So I started working on AI.
But that was years ago, before the AI hype got going.
100%. I think everyone in this room probably knows that people have been using various iterations of AI for maybe a decade or so, something like that. But I first started working on it maybe in 2017, and that was looking at an ethical framework for AI, governance, risk, and controls around the use and deployment of AI. And now, of course, everyone is very focused on AI, and it's because I think because of generative AI. This is a complete leap forward in not just predictive analysis, but generative analysis. So I think that's why it's really caught the attention. Then you have the very buzzy startups and big valuations and things like that. So on the one hand, AI is incredibly boring because AI and machine learning, for the most part, has been used and has continued to be some of the most important use cases to do operational efficiency. It is to analyze vast amounts of data. It is to do, to identify and connect patterns. Mm-hmm. It is to automate processes, robotic process automation, and things like that. I almost feel that AI is finally perhaps, and generative AI is finally perhaps the solution to just the deluge of data that has been created ever since the advent of the internet. I know because when I go to search things, so I'll do two things. I will search things on Google, but then I will also go and use Gemini and ask the questions on Gemini. And it's very interesting to use it to basically filter out a lot of junk.
Curate.
Exactly, because now you feel like you have a better sourced, it's not like clickbait that you're getting. Mm-hmm. It seems so. I used it for travel itineraries, for example. So I think that's some of the potential of it, right? Just being able to analyze and organize and process vast amounts of data. But anyway, when we look at the financial industry and financial institutions for the most part, you can break it into two categories. There's the internal use cases and there's the external or client-facing use cases. Right. And by far, it is the internal use cases that people have been using it for. Some of the most interesting and areas where people are focused on, people are looking at trying to analyze trading activity and things like that to help better support clients. A financial advisor can have a dashboard that sort of better portrays or more quickly or easily portrays that kind of analysis. But otherwise, it's really just operational efficiency. The external part, the client-facing part, because of the incredible importance of having the appropriate governance, risk, and control frameworks around the deployment of AI, particularly when it's client-facing. Mm-hmm. I have heard that most institutions, and this is the same from before and now that I'm a commissioner, most institutions are going very slowly in deploying external client-facing use cases. It is much more about process efficiency and things like that. And I think if you look at, for example, consulting firms and what they're doing with generative AI, it's really to generate PowerPoints. It's to go through and pull all of the information that they've got across their different partners or practice groups and to be able to synthesize and bring that together more quickly. And it's the same thing, I think, when you look at maybe what is happening in investment banking. You can kind of get the first draft of a pitch deck much
And then you refine from there.
Of course. And I think that's the big thing about AI is I believe that in the first instance, you are going to have a lot more job creation in AI because you will need humans to check the AI. Mm-hmm, mm-hmm. There will need to be a human involved. I've done AI to sort of generative AI to kind of do a little bit of like very basic legal research, things like I learned and forgot in the first year of law school. And it's not quite right. It's pretty good, but it's not quite right. And it's that part that it's not quite right that as firms are deploying it, I think you're going to need to think about basically your operational risk management or your legal risk management around using generative AI. And anyway, you'll need to hire humans to do the monitoring and the testing and the checking and things like that.
Do you think there needs to be regulations with regard to how companies and other institutions that the CFT does oversee when it comes to AI in trading and in markets? I mean, where are we in that continuum?
Yeah. There's been a lot of attention on the use of AI in trading and markets. So I'll kind of answer this question in maybe two parts. So the first is how are regulators around the world generally approaching the regulation of AI? And so I think it really is two lenses. First, when you're talking about risk governance, regulators, prudential regulators generally all agree that you take a principles-based approach, and the existing risk governance frameworks that banks and other financial institutions are subject to are the exact same things that you apply to the use and deployment of AI. So your operational risk management, your model risk management, that's very important. Looking at technology change management, all of those things, it's flexible, it's principles-based. It really shouldn't matter what activity you're engaging in. You have to make sure you're running it through your risk governance framework. So that's on the one hand. That's when you're thinking about how do you regulate the risks of AI. The other lens that regulators are approaching it from, and the one that I think has gotten a lot of attention lately, is how do you address market conduct, fraud, abuse, manipulation. And typically those rules are more prescriptive. And so you have prescriptive rules that are being proposed around the use of AI and particularly client-facing applications. And where I have spoken, like I just spoke at the IOSCO annual meeting and discussed AI and RegTech and SupTech, regulators need to be careful to not confuse the two. So we should use a principles-based approach for risk governance, not a prescriptive approach to risk governance, because it should be a technology-neutral approach. Technology is always evolving. And then appropriately use prescriptive rules around market conduct and market integrity. But again, you want to strike that right balance between allowing for innovation, but then also protecting against.
Not choking it off.
Yeah, exactly.
How does that compare with how regulators in other parts of the world are approaching this?
That is how regulators, and that's generally, so all the regulators around the world. Yeah, so this is a kind of a top of house view of all the regulators around the world and how they're generally approaching it. When it comes to, coming back to the first part of your question, the regulation of AI in trading and markets specifically, and maybe what we're seeing in the United States, I think that the sensible place to start would be that a lot of the risks and issues that we see with the use of AI for trading and markets applications is very similar to the use of algorithmic trading. When algorithmic trading first was developed and deployed, a lot of these same concerns were there. And we have indeed come up with regulatory frameworks around the use of algorithmic trading. And there was the flash crash that was involved both the SEC and the CFTC. There was a joint report that was made, and that led to reforms like the SEC's market access rule, and the CFTC has some system safeguards rules. But those are risk limits, fat finger controls, monitoring, things like that. And I think that that's where we should start when we think about regulating AI in trading and markets. And if we find that these existing control frameworks around, algorithmic trading, electronic trading, that kind of thing, for example, need to be, topped up, right? If there's gaps or things like that, then we should do it. But it should be a methodical, but there should be a gap analysis, and there should be a methodical way to do it. I think the reflexive approach in Washington is often kind of a knee-jerk reaction, and then you want to come out with a lot of rules and that kind of thing. And I think this is one where it's better to take a more data-driven, market observation-based approach. Now, one of the things that people have pointed to with the use of AI in trading and markets is that it will accelerate, concentration risk and herding behaviors and things like that. And that's
true. Trades, all of that.
Right. AI, because of the speed of what AI can do, it does have it adds velocity to the existing risks and concerns that you have that are out there. But at any rate, I find that people find a lot more promise in AI for risk management purposes. Being able to pull together a lot of structured and unstructured data to be able to predict different risks that are appearing around the world. I think for geopolitical risk in particular, and then FX markets kind of comes in with that too. How do you use AI to help better understand the emerging risks and things like that?
Is that how the CFTC itself is using AI right now? How are you deploying it?
So the CFTC has just recently done a request for comment on the use of artificial intelligence in our markets. And so we've received a lot of comment letters on that. The staff are currently reviewing it and looking through it. When supervisors use technology, people are calling it SupTech these days. And
why is it SupTech?
Supervisory technology.
Got it.
SupTech.
Washington always has its own abbreviations.
It's really
CFTC, OCC, SEC.
It's really caught on. I think a lot of the promising applications for regulators with AI is, of course, to enhance our monitoring and surveillance functions.
Yeah.
So just the same way that a lot of firms are using AI for market surveillance, that's something that, of course, regulators can do as well. The IRS, I believe, and maybe OFAC or FinCEN, or all of them, are using AI to better detect fraud and illicit finance and things like that. So certainly market surveillance is important. I think the other thing, though, with generative AI, and I think we are pretty far away from this, but something that agencies should be looking at is how do we use generative AI to help make our examination functions more efficient and to process the vast amount of filings, for example, that we have. So annual compliance reports can be hundreds of pages long. You can use generative AI to kind of extract sort of the key things, or you can have it analyze 5 years worth of annual compliance reports and then identify trends and things like that. If you can have generative AI help to create like a first draft of an exam report, that's an incredible time savings. But this is no different than what people are already looking at in the assurance, the audit and assurance professions, right?
Do you think AI will speed up some of the responses that government gives to different scenarios? I mean, one complaint or one concern, I suppose, that markets always have is that the government response is slow, middling, and maybe AI will change the velocity of that.
I think it would be great to use AI to improve government efficiency. I actually recently gave a statement where I talked about how we should be approaching modernizing and utilizing new technology to make government more efficient. And of course, when people have applications pending before a regulator, it can be 2-3 years, hopefully not 3, but it can be 2 years before they actually get an approval or a rejection of their application. Well, if you're a startup, particularly if you're a startup that's in the technology field, 2 years is an eternity.
You don't have that time.
There is a regulatory burn rate. And I gave a statement about this in 2022, where the decisions that we make and the inefficiencies in government has a real impact on commercial ventures. And we should be mindful of that. We're here to serve the public. We're here to support the markets and to ensure market integrity. And so I think we should understand that there's a real cost to what we do.
Let's talk about T+1. Last week, U.S. capital markets transitioned to one-day settlement of trades, better known as T+1, and the CFTC's Global Markets Advisory Committee, which you sponsor, Commissioner Pham, has been doing work ahead of this change. You've issued some resources on this. First, just let's take a step back for a moment. Why is T+1 so important?
So one of the things that people really were pushing for, and I think we've already seen in these early days that these benefits have been realized, is looking at the capital efficiencies. If you are T+1 and not T+2, there's a tremendous amount of capital and collateral that is then freed up and can be deployed for other purposes. And so I think that, of course, was a huge aspect of it. It's also to mitigate certain risks. So when there was a lot of the, particularly in the equity markets, security, T+1 security settlement. So when you had like the meme stock craze and GameStop and a lot of different things, it kind of showed some of the, I don't want to say fragility, but something like that in the current market structure. And so it was really impressive to see both the regulator and the securities industry come together to identify reforms that will help to mitigate those risks, to make the securities markets more efficient. And I think we've seen that. So the settlement fails have been very low, and the affirmation rates are very high. And of course, there's been, I think DTCC published a report on this, but I think maybe $3 billion or so of freed up capital. So it's really been very promising.
So no significant or meaningful hiccups since implementation last week?
No, not that I've heard. And I had a couple calls to kind of see how things were going, and it seems that everything went very smoothly. So one of the ways that you can think about this is comparing when the industry went from T+3 to T+2. After that exercise, you had a number of calls that needed to be like cleanup fails or fails cleanup calls, and that needed to, and they had to do a couple of different industry-wide exercises to do that. That's not been needed this time around because the fail rate has been so low. So that's been very promising. I think one of the other things that is different about the transition from T+3 to T+2 and now from T+2 to T+1 is T+3 to T+2 was really doing the existing processes and workflows the same but faster, like trying to get everybody to like do it faster. For the shift from T+2 to T+1, it has really been more about process reengineering. What are new, now there's a lot more automation, even in the last couple of years, there's been a lot more automation of different workflows and processes, middle office, back office. That's all enabled to do some process reengineering, find some real efficiency gains. And so it's really a new operating model, I think, around clearing and settlement. And then that's why we've seen so much success in moving to T+1.
So by moving to one-day settlement, though, you look at what the U.S. is doing, it's really leaving behind many jurisdictions outside of the United States. And as you know, the currency market is a two-way trade, right? You buy one currency, you sell another country's currency. You buy the dollar, you sell another country's currency, or you buy another country's currency, you sell the dollar. Do you see any risks for FX trading in this transition that need to be addressed right now?
So that was something that people were very concerned about. That was part of the aspect of the GMAC recommendations, was trying to provide resources to support the impact it could have in the FX markets and things like that, for example. And what seems to have been proven out so far, knock on wood, but from what I've heard, there hasn't actually been a lot of those concerns about issues on the FX leg of the transaction haven't come to fruition. So liquidity has not seemed to be impacted. There is more volume happening in kind of that 3 to 5 or 4 to 6 period of time. But the
U.S.
volume,
hours.
Yeah, but the volume has been handled. And I think what we've seen is that the entire industry came together. I was talking to SIFMA. SIFMA said that they had several thousand people on these calls that were being done in the run-up to the T+1 transition, including participants from other jurisdictions, both the sell side and the buy side, to make sure that everything was going to be working smoothly and efficiently. And so I'm pleased to hear that the concerns around the FX leg don't seem to have, those fears have not been realized at this time.
Right. But we go back to that idea about the U.S. moving in a different direction than perhaps other countries when it comes to regulation or rules or guidelines that they put in place. Can you compare and contrast the U.S. framework on approaching new technology, innovation versus other countries? Are we slower than other countries? Are we moving quickly enough?
We're always faster, but that's the reason why the best and brightest come from all over the world to the United States is because of the opportunities that are here and the plentiful funding, right? So we have amazing universities. We have incredible different sources of funding. We have a very thriving public equity capital markets. So we really are bringing the best and brightest because of what we have here in the United States. We also have tremendous innovation. Look at all of the trillion-dollar companies, right? These are U.S. companies. I think and for the most part, our regulatory framework is tech neutral and allows for that experimentation. Also, it helps that we have the U.S. system of federalism, so we have the federal level and the state level, and the states are sort of the experimental laboratories of the United States, right? But when the sort of informal coordination and working together of the various authorities, in the United States we have an incredibly complex regulatory environment. So not only
back to the alphabet soup.
Exactly. Not only do we have the 50 states, but for the federal financial regulators, we have 5 major ones and a couple more. So other countries have what's called a single peak or twin peaks model, right? One regulator or maybe 2.
Like the FSA in the UK.
Exactly. We have a whole mountain range. And but anyway, so when that interagency coordination doesn't work so well, and it is mostly informal, that's when you start to see these growing pains, and I think that's why it's really dominated the conversation in the digital asset space.
Okay, let's talk about global payment system. I think this is something else that folks in the FX space are paying attention to. As anyone who regularly, As anyone who regularly makes payments to someone else overseas or some institution overseas, it's expensive, it's slow, it's cumbersome, certainly more than it needs to be. Do you see opportunities for blockchain technology and digital assets to provide a solution here, a practical solution and a solution that can work?
Yes, so this is what central banks and commercial banks have been exploring for many years at this point in time. Almost 10 years, actually, looking at tokenization, looking at blockchain technology, and how that can address inefficiencies. So the BIS, the Bank for International Settlements, has been leading. They have a BIS Innovation Hub. They've been leading a number of cross-jurisdictional projects So one of their major initiatives is around cross-border payments and remittances and trying to modernize cross-border payments. And then another big focus is around what's being called next generation financial market infrastructures. So this could be exchanges, other types of payment networks, and so on. And that's something where, for example, the Banque de France and I think also the Bank of England have been working together on some automated market makers in the FX markets, for example, really looking at wholesale use cases and applications. And so it's very active study, a lot of experimentation going on.
I also want to bring your attention to events contracts. This is something that really interested me, I know, because Bloomberg has been reporting that the CFTC is now considering an outright ban on events contracts. So what that means is no formal options tradings on things like sports games, the Super Bowl or the NBA Finals, the Oscars, the Grammys, award ceremonies, elections. There are 5 commissioners at the CFTC who would be voting on this that eventually will make the decision. What's your thinking on this right now?
So we just recently had our open meeting where we voted on the proposal, and it passed. Right, it was a 3-2 vote, and it passed. And so now that's an open consultation period where people are looking at it. So I actually think I am restricted from talking about things during an open consultation period, but maybe I will talk about around it.
Please.
So the CFTC has long had jurisdiction since Dodd-Frank over event contracts. So, for example, a swap is an event contract, just some kind of contingent event that happens. And even before then. So there are event contracts that have been around since 1992 on, for example, weather derivatives. Is it going to rain or not rain? This is very important to farmers and producers and things like that. These are really important. There are event contracts on, like the CPI, on inflationary measures, on any number of benchmarks or things like that. And a lot of the concern and what I put into my public statement at that open meeting on the proposal was people have talked about the CFTC having to become the primary overseer of elections. Well, there's an agency called the Federal Election Commission, which that is their primary mandate. And we have weather derivatives, and we are not the weather police. There are derivatives based on changes in interest rates, and we're not policing the Fed on how they change interest rates. There are interest rates on state insurance contracts, and we are not the police of insurers, which are the domain of states. So, I think that's an argument that doesn't hold water when you consider all of the very many different kinds of event contracts that we've had since 1992. Now, the innovation here, or innovation-ish, is some of those examples that you gave. And what I think we really should be focused on is retail binary options. If what we are concerned about is fraud and abuse of retail, and these sort of direct access models, then we need to go and think about regulating retail binary options, because that's actually the risks and the fraud.
You mean my call option on NVIDIA, for instance?
Well, it's a yes or no. No, it's like, is I don't know, is Natalie Portman going to win an Oscar? Yes or no. That's a binary option.
Okay.
The thing that we also need to be thinking about is that there are prediction markets all over the world. Other jurisdictions regulate prediction markets, and they have been proven time and time again in academic and other studies to be very effective. What people are worried about in a broader sense is how can we support prediction markets in the United States, or are they going to be banned? Right, and I think that's why there's a lot of really important things to parse through when we think about event contracts, because again, swaps are event contracts. So are we banning all derivatives now?
Yeah, well, if the U.S. bans it, there's always somewhere else to go to. The internet
100%.
makes that possible.
Absolutely. So, and that's in fact what people are doing. People are in the United States trading on offshore prediction markets.
Okay. Thank you so much. I want to leave it there. Caroline Pham is commissioner of the CFTC. Really appreciate your joining us. And if there's one government agency that is most least appreciated, what would you say that is? We talked about which one is the most misunderstood, and folks here thought it was the OCC.
It's the CFTC, clearly.
That was an easy layup. Thank you so much.
Thank you. Thanks so much for having me.